my business partner and friend, Miss Monica Castaneda. And we are just very passionate about this call because, for one, that is how I was introduced to the financial services industry when I had my first child about a month after having him, or maybe even just a few weeks after. My family, my relatives came over to visit, and they shared this amazing plan with me. And during a time when I was very overwhelmed as a first time mother, I did gain peace of mind from them that at least I was providing a strong financial foundation for my son and my children. So I apologize, I am on a different computer and I am trying to find I can even slide it here. Forgive me, guys. No, I sent it to you. Let's see. Let's see. Big Monica is waving at you.
Hello, Perlina.
All right, you guys. So sorry about that. Thank you for your patience. I am going to share my screen here, and then I'm going to pass it on to Monica, who's going to share a little bit about herself and why this plan is so important to her as well. All right, Miss Monica, the mic is yours.
Thank you, Marlena. You can hear me okay?
I can hear you.
Uh,
Yes.
Okay, good. So, thank you so much. I'm honored to be here with all of you this evening. The Million Dollar Baby Plan is actually one of my favorite presentations. It really hits close to home as a mother and a grandmother. So, I actually personally have this plan set up for my youngest grandson, David. He just turned a year old in March. And my goal is to build and secure his financial future for years to come. But before we dive into the details of the Million Dollar Baby Plan, I want to take a moment to talk about the current financial reality that so many families in our country are facing today. Here at OIC, our mission is to empower people through financial education and entrepreneurial mentorship. Currently, 60 to 7% of Americans live paycheck to paycheck. That means even people with good jobs are struggling just to keep up because things are just getting so expensive these days. 47% of Americans can't even afford a $1,000 emergency without borrowing from either someone or putting it on a credit card. So, if someone has a flat tire or say one of your major appliances goes out, that could lead to real financial stress. The average American household carries over $104,000 in debt. Imagine that. I have worked with individuals along the financial spectrum, and they all feel like their money just goes right back out. They get their paycheck and they got to pay everything out. So, earning more doesn't always mean keeping more. And what about our younger generation? The average college graduate leaves school with about $37,853 in student loan debt. Imagine starting your first real job and then realizing hundreds of dollars coming out of your paycheck already spoken for. That's the real difficult financial weight that delays, most of our younger generation's futures. And the average monthly Social Security benefit for retirees this year is just $1,976 per month. That's less than $24,000 a year. Can you imagine working 40 years only retire on that amount? Between rent, groceries, and medical expenses, we really wonder why it's so hard to keep up with inflation. The average 401k or 403b balance on at age 60 is about $240,000. That's only about $20,000 per year. So between Social Security and your retirement savings, many retirees are looking at under $35,000 a year before taxes. Another reason people struggle is job changes. On average, a person changes careers every 4 years and even less time amongst those age 35 and younger. So every time they switch a job, many don't transfer or continue their retirement accounts. Some of them just cash it out, thinking that, it's just a small amount. But that small amount actually can double or triple by the time they retire. And that's exactly why I'm so passionate about financial literacy and long-term planning. Statistics like these aren't just numbers. They're real people, real families like you, and real futures. You know, those families have futures. So that's what inspired me to share the Million Dollar Baby Plan, a simple, powerful way to start building wealth early. It's the same plan I started for my grandson when he was only 2 months old, because I want to rewrite his story. I don't want him living paycheck to paycheck. I don't want him worried about how he's going to afford emergencies or retirement. So we're going to go to the next slide, which is the video. We're going to show you a 2-minute video that summarizes what the Million Dollar Baby Plan is all about. Then we're going to take a deeper dive and go into the benefits of how it works and how you can start a plan for your child. Can we get the video going? Okay, I think we just lost Marlena, but not a problem. When she comes on, she'll go ahead and show us that video. I hope so far everything's interesting to everybody. Okay, so you're getting on. Sorry about this. Sorry about we're gonna get it going pretty soon.
Oh, so sorry,
Thank you,
guys.
everybody.
Sorry. One moment.
Today I'm taking care of my grandson, so excuse me if I have some stuff on my shirt. My million dollar baby grandson, I'm taking care of him. Really quick. Show my dollar baby. See your face. There we go.
Were you guys able to hear that? Hi, baby.
He's so cute.
No,
No. Okay,
no, we
wonderful.
couldn't hear it.
Forgive
This is
us.
my million dollar baby here.
Okay. Okay. One more time. Yeah. Here we go. Here we go.
A long time ago. So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Index Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
I just love that video. It's so informative, and you just saw my little $1 million baby on Zoom with me right now. So the $1 million baby plan actually uses an Index Universal Life, an IUL insurance policy, which is a financial strategy designed to build generational wealth. It involves purchasing an IUL for a child at a young age, just like my grandson, I did it at 2 months, and funding it over time to accumulate cash value. The goal is to create lifelong financial benefits, including tax advantage growth, a death benefit, and the ability to grow against the policy for major life expenses. The top 3 benefits of the $1 million baby plan. So there's cash value growth. A parent, a grandparent like myself, or a legal guardian can actually open up an IUL policy for the child. Premiums are paid into the policy, which grows in cash value based on an index interest strategy. For example, the S&P 500 performance, with the cap and the floor. So to understand how index works, we need to understand how money grows. So what is an index strategy, an index interest strategy? So with a fixed strategy, your interest rate is locked in. Okay, you know exactly how much money is going to grow. Okay, maybe 1%, 2% every year. You know what your principal is, that's going to be safe and guaranteed. Your money is never going to lose value no matter what happens in the market. Common examples of the fixed accounts include your savings account or a traditional CD. The trade-off is that while your money is protected, your growth is limited. Okay, the next one is the variable strategy. This one is more unpredictable. So it offers great potential for growth, but also carries a higher risk of loss, especially when the market goes down, like it has been lately. This is the type of strategy you're going to see in your 401k, your 403b, or individual stocks. So when the market performs well, your account grows, but when the market dips, your balance can drop too. So this is where the index strategy comes in. Think of it as, say, the middle ground, a balance between growth potential and protection. So an index account mirrors the performance of a market index like the S&P 500, but your money's not directly invested in the market. Okay, that means that you get to participate in the upside when the market does well. Okay, but you're protected from the downside when it drops. You're going to typically see the strategy in life insurance products such as the $1 million baby plan. Remember, the whole purpose of insurance is to transfer risk. You're going to shift the risk of loss from you to the insurance company. Okay, with an index strategy, the insurance company gives you a guaranteed floor of 0%, which means that even in the worst case scenario, like when the market dropped 30% or 40% in 2008, or even, 2022, your account's not going to lose a single penny. You may not earn interest that year, but your money's going to stay protected. So unlike the variable strategy, when you could lose part of your investment, okay, the index strategy gives you peace of mind. knowing you have no downside risk and still have room to grow when the market rises. That's why so many families, including my own, use the index-based strategies to build long-term wealth, especially for plans like the Million Dollar Baby, where protection and steady growth are key. So the tax advantages, you're probably asking yourself, why life insurance? Because when the cash value is tied into life insurance, there's tax advantages. The cash value within the policy grows tax deferred, meaning you're not going to pay taxes on the growth as it occurs. Your child can later access this cash value tax-free, okay, through the policy loans for education, say a home purchase, retirement, even a down payment on a car. So the wealth transfer and legacy. Your child can continue funding the policy into adulthood, allowing it to grow into a potential $1 million asset. Upon the insured's passing, the beneficiaries receive a tax-free death benefit. So imagine this. If your child eventually has a policy worth $2 million, that $2 million is going to go directly to the next generation, completely tax-free. Think about it. What if this happened in your family? Would this have completely changed your financial future? I mean, your story? And think about all the opportunities it would create for generations to come. This is what true legacy looks like. It's not just about money. It's about giving your children and grandchildren the freedom to dream bigger, to live better, and to continue passing on that legacy. Okay, so now I'm going to send it over to Marlena, where she's going to go ahead and talk about the comparisons of an IUL to other plans. Thank you so much.
Awesome. Thank you so much, Monica, for that information. Thank you all for your patience with our technical difficulties and for still sticking with us. But like I told you guys in the beginning, when I was first introduced to this plan, I was a first-time mom, very overwhelmed about all of it, realizing I was in charge of a whole human life. I had to do all the decisions for that person, right? And learning about this plan really did give me peace of mind when it came to saving for his financial future, right? But probably like many of you, before ever hearing about this $1 million baby plan, I looked into different types of plans, right? CDs, high yield savings, 529 plans. So maybe you have done the same thing and you want to know how this compares to the $1 million baby plan, right? So top features that people look for when they're looking at long-term savings and investment strategies are these features here on the left, right? Is there growth potential? Anything that we put our money in, ideally we want our money to grow, right? So does it have growth potential? All three of those check that off. Safety and protection, right? So this is against the market. Is your money safe against the market? In a high yield savings account, yes, you do have protection against market risk, and same with 529. Tax advantages is where they start to differ, right? And a 529 plan, you do have tax advantages where you can do post-tax contributions, and the money that you access is tax-free. Liquidity, high yield savings does give you more liquidity. You're able to access your funds. 529 is only accessible specifically for education, right? Guaranteed benefits, a high yield savings and a 529 plan do not have either of those. Flexibility. There is flexibility in a high yield savings as far as what you can contribute, when you can access it. Again, with a 529 plan, the money that is contributed into that plan is specifically for education purposes only, right? So if your child chooses not to go to college, then you will have to pay taxes, penalties to access that money, or you yourself will have to go to college, or you can, as it says here, there is legacy and wealth transfer. And there is a checkbox there for the 529 plan. And that means that you can transfer this either to another child or even to the next generation if it's not used, but still it needs to be used for education, right? Protection against inflation. The 529 plan is checked off there because generally the interest on those plans are higher than the inflation rate, but we have seen that the inflation rate has increased recently. So we don't know how much longer that will be. And then this last one on here says does not affect financial aid, right? And they did touch on that a little bit in the video. But just like Monica said, why life insurance, right? Life insurance gives you those certain tax advantages as well as this protection because it does not show as an income or an asset when you're applying for financial aid. So if you have a 529 plan, that will count as an income, as an asset. Same with your high yield savings account. So if you've been saving in this 529 plan since your baby was born, now they're 18 and you have a few $100,000 in there for college, then they may deny you for financial aid because it looks like you do have the money for that education, right? In a 529 plan, what people have been doing for decades and even centuries is they start a plan like this for their child early, contribute into the plan, they sign up for that financial aid when their child goes to college, which allows the money in their $1 million baby plan to continue to compound for another 4, 5, 6 years. And then once they are done, they use that cash value accumulation in that $1 million baby plan to then help pay off those student loans so their child is not only taken care of as far as for college, but not starting their adulthood with debt. Okay, so very, very powerful plan. And just to summarize all of the benefits that the video and Monica and myself have talked about, number one is that tax advantage growth, right? Cash value grows without immediate taxation. So the money that you put in there, you're not getting a tax bill every year for all of the growth that happens within that account. A market protection where your gains are capped, but there is a floor to prevent losses. So we like to say zero is your hero. That 0% floor protects you against any market loss. Legacy and death benefit, which provides that financial security for future generations. Flexible access to your funds, which you can access through loans that can be taken tax-free for major life events and expenses. And then this one is my favorite that we don't talk about enough is that the contributions that you make into this account are going to come back to you one way or another, right? So unlike your car insurance, if you pay car insurance for 20 years, you never get in an accident, you're not going to get any of that money back, but you are just paying for that peace of mind that just in case something happened, you have that protection, right? In this case, whatever is contributed into this plan is going to come back to you and your family in one way or another, either through that cash value, that savings bucket, living benefits, which we'll talk about a little bit more when we go over some uh, real life illustrations, income, which again we'll go over on the illustration. So you can create what's called a pension-like income in this plan for your child or even for yourself. And then the death benefit. Let's say they are all set, they had a good job, they have their retirement set, they're healthy, they don't need the living benefits, they don't need to touch the cash. They still have that death benefit to then pass on to the next generation and truly live that legacy for the family. So hopefully at this point, you guys heard all of this information and you're thinking, how do I set up $1 million baby plan for my child, right? So the process is very simple. Number one, you want to choose a reputable insurance company. So you want to look for an insurer that has a strong financial rating. The providers that we work with have an A or higher rating. Many of them have been in business for over a century, 177 years. So they have been through depression, recession, pandemic, all the things, and are still a very successful, strong company with an A plus rating. But you also want to make sure that company has favorable IUL products for children. So when I was first introduced to this IUL plan in 2014, there were no living benefits for children. A few years back, they started offering living benefits for children, so I opened another policy for all of my kids to make sure that they had those living benefits in place for them as well. So you want to make sure the company has a favorable IUL product for children. And then structuring the plan properly, right? So the parent or the guardian will own the policy, the child is going to be the insured, and then you'll sit down for this whole process, you'll sit down with a financial professional like either myself or Monica or the person that invited you onto this call, and we can help you choose the coverage, the funding strategy, and how understand how to maximize that long-term cash value growth that aligns with your goals and your needs and objectives. And then we want to make sure that you understand how this policy, how this plan grows and what protection features are available, right? So the market index growth potential, which Monica went through pretty thoroughly, the downside protection with the cap and floor strategies, tax advantage loan and withdrawal options, and then optional riders for future insurability and long-term care. So these are those living benefits I'm talking about. And the great thing about starting these plans early, I know my parents, when they first heard about life insurance for children, they're like, why do children need insurance? Why do they need life insurance, right? But life insurance has really evolved from what they knew of life insurance. Back then, life insurance was you have to die in order for your family to get the money. And oftentimes it was a term policy, so only covered them for about 30 years. And of course, we pray that our children will make it past 30 years, so it makes no sense to put something in place like that for them, right? But again, life insurance has really evolved and now has all of these features, such as the cash value and the tax protection and living benefits for children. Then you would apply and fund the policy. So again, because life insurance is based on age and health, children are young and generally pretty healthy, so it's minimal underwriting for most children. And you can begin funding early and maximize that compounding growth. So again, I will show you an example of that in just a moment. And then the policy ownership can transfer to the child in adulthood, right? Because we are not doing this just to put money away and not pass on this financial education to our children. We want them to understand also how to continue this for themselves and for the next generations. So, as the scripture says, train up a child in a way he should go. Even when he is old, he will not depart from it. So that is our goal here, right? We don't only want to set our kids up for success, but we want to teach them and show them how to carry that on to future generations. So next we are just going to go over probably another 10 minutes at most, but I just want to go over some real illustrations that we have here, right? So this illustration is for one of my business partners, her son, King David. Again, she was in the same boat. She started a plan for him when he was just one, but there were no living benefits available back then. So once she learned about a plan that had living benefits for juveniles, for children, she started another plan for her son at the age of 9. And in this example, we're going to call him Mr. Start Early. Okay. So here, his parents are putting away $100 a month into this plan, and they will gradually increase as time goes on. If something were to happen to him, God forbid, right? If he were to die too soon, this plan has a death benefit, and his family would receive $186,386. And this doesn't mean we're putting these plans in place because we want to have financial gain over the loss of our child, right? But we also do not want to have to put GoFundMe's out there and have to rush back to work if something tragic like that happened, right? So having this death benefit helps in that sense. This is what we've been talking about mostly, right? What if he lives a long life and he just needs some cash, right? He needs cash. He wants to take a loan. If you take a look at these numbers here at age 69, this is why we call this a $1 million baby plan, because starting with as little as $100 a month in this plan, this can be an almost $2 million cash value product for King David at age 69, right? 1,956,365. So if you guys are taking notes, if anybody is taking notes, actually, Miss Perlina, can I have a pen? Thank you, ma'am. Actually, I'm gonna, okay, so write down that number, right? 1,956,365. And I want you guys to just have that number ready so you can understand why we call him Mr. Start Early, and the next example will be Mr. Start Late, right? Because time really is more important than money. If he does not access that money at age 69, it will continue to grow and compound even though they are no longer contributing. It can be 2.7 million at age 74. If we look at age 84, over $5 million just because his parents started putting money away in the right vehicle, right? Instead of a low interest bank account or just in their house, right? In a shoebox or under the bed. But this last one on here is one that a lot of people overlook when they are planning for their financial future and building wealth. And that is, what if I become ill, right? What if I become ill? What if I become sick? Or what if something happens, but I didn't die and I'm no longer able to work? How will I continue to be able to provide for my family, for myself, right? So that's where these living benefits come in. And it's amazing that we have these available for our children now. So if something were to happen to King David and he was diagnosed with a terminal illness, at age 65, he would have access to $1.5 million that he can use however he chooses, right? He does not have to provide medical receipts. Once he is diagnosed by the doctor for this specific company, the criteria is 24 months or less to live. Some companies that have terminal illness, it may be 12 months or less. But this is something that I saw in action firsthand. So my cousin that introduced me to this industry, she had a plan like this in place. She did not have children yet, but she knew she wanted kids, right? So she had about 1.5 million in coverage for herself and life insurance with living benefits. Unfortunately, in her pursuit to have children, she had to have a surgery of what they thought were fibroids removed, and later on found out that was actually a very rare form of a terminal cancer, and she was given 6 months to live. Okay. So she was able to access this money here as a living benefit. And what I saw was her husband was able to be by her side 24/7 for those 6 months that she made it, right? She was diagnosed in January and passed away in the end at the end of June. So this month will be her, gosh, I don't even know, 9-year anniversary. Yeah, 9-year anniversary. But that money, not only did it allow for her husband to stay by her side those final days, her mother also was able to do the same. She's also um, in this industry and was able to take some time off and be next to her firstborn daughter's side every moment that was possible. But they didn't have children, right? We talk about legacy and wealth building, and sometimes people think like, oh, I don't even want to have kids. I don't have anybody I want to pass it on to, right? But Lee was different. She didn't have children, but she still wanted to leave a legacy and help the next generations. So in that 6 months, they were not able to spend that $1.5 million. So she told her husband while she was on her deathbed, she was researching which country is the lowest on as far as literacy, right? And she found Bali, Indonesia. And they chose Bali, Indonesia to build schools for underprivileged children, provide books for them, provide transportation in forms of buses, because many of them are walking with holes in their shoes, right? Miles to school. So as of today, there are 5 schools in Bali, Indonesia, uh, named after my cousin Leonore Calastro because she had a plan like this in place, right? So it is a lot more than just leaving money for your children, right? It really is, what type of legacy do you want to leave in this world? What kind of impact do you want to leave? And this can really help you do that one way or another, whether it's that cash value accumulation or if God forbid something happened to you, you can utilize that money however you want, right? Okay, before I get too emotional, I'm going to move on. Let's look at how this plan worked for King David, okay? So his parents said, we're going to put $100 a month, which is $1,200 a year. We're going to do that for the first 5 years. But they are building their careers, they're building their businesses, they're anticipating their income to increase. So from years 5 to 10, they're going to double it and start putting $200 a month, right? 2,400 a year. And then once King David is an adult, they're going to teach him how to properly save his money. And they're going to say, son, we're still going to contribute into your plan 200, but we want you to match what we're putting and you put 200 as well, right? So from age 19 to age 45, they're going to be putting $4,800 per year into this plan, and then they're going to stop. They're not going to contribute any more into this plan. As you see, over that 37-year period of time, they contributed 147,600. But if we look in this column here that says accumulated value, we see that his money has grown to $412,108. So already right there, that's a pretty good return on investment, right? But he's young. Like I said, time sometimes matters a lot more than money. So he has time to let his money continue to grow and compound without them having to continue to contribute. So at age 49, we see there's 533,000 in the cash value. And if God forbid, you remember that death benefit of 186,000 that we saw in the beginning, that has now grown to over $1 million because of that cash value growth that's added to the death benefit, right? So again, $1 million baby plan. At age 60, he'll have $1 million in his cash value. Age 72 million. By age 80, we see 4 million in death benefit, almost 4 million in cash value, right? Again, just from putting 147,600 in the right financial vehicle. Okay. Let me see. I see a chat. Is there a question in here? Awesome. Thank you, Miss Shelley. So next we're going to look at a young adult that I sat with. He was 23. We're going to call him Mr. Start Late, right? Really, he's still starting pretty early in his life, but he didn't start as a baby, right? So some of you might think, I'm not a baby. I don't have a baby. Can I still do this plan? Absolutely. I didn't start mine until I was in my 30s. This young man, 23, right? The difference here is we talked a lot about um, Social Security, right? He's like, oh, but I'll have Social Security. So we talked a little bit about that, right? And as you see here, same structure. He's going to start with a little bit more, $150 a month. If God forbid he died too soon, 167,000 will go to his family to help with his final expenses and give them a little cushion. If he needs cash, here as you see, it's structured a little bit different because on this one, we turned on what's called the lifetime income benefit rider, right? So here, this is a pension-like income that he cannot outlive, which is important because the number one thing that retirees are afraid of is outliving their money, okay? So if you take a look here, this is saying at age 70, he would have access to $6,579 per month for the rest of his life. Okay. So when we were talking about Social Security, if you were paying attention to what Monica said in the beginning, the average Social Security benefit is just under $2,000, right? 1,900 something. So I wanted to see what is the maximum. So I did a little research, and last year in 2025, the maximum that somebody can get in a Social Security benefit was a little over $5,100 a month. But there were certain criteria they had to meet, right? So number one, they had to work at least 35 years. Number two, they had to make the maximum taxable wages, which in 2025 was $176,000 per year. So if we just look at that right there, you have to make $176,000 per year just to get a little over $60,000 a year from Social Security. So that is over $100,000 change in lifestyle, right? Drop in your income when you retire. That's a huge shift in your lifestyle if that's the only thing you're relying on, right? And then lastly, you had to wait until age 70 to access that benefit, right? So I use some of those numbers to plug in here so he can see a comparison. Again, all of those living benefits are still available to him. I didn't even go past the terminal because I got stuck on talking about my cousin, but there is also chronic illness benefit of 22,652 that he can have access to if he were to have a chronic illness, which is losing two of his activities of daily living. If he had a critical illness like a heart attack or brain aneurysm, he would have access to almost $1 million, 932,000. Again, critical injury, the same. And Alzheimer's benefit, which is a new living benefit that I've seen just within the last couple of years. But Alzheimer's is really on the rise. And they say because we're on screen so much, it's really affecting our brains. So he would have access to a 1,132,244 in a lump sum to help with care. And really, that Alzheimer benefit, I always tell my clients, I look at that more of a benefit for your family. If this is a plan that you're putting in place for yourself, most people, people that have Alzheimer's, they don't know what's going on most of the time, right? They are not really the ones suffering. It's the ones that are taking care of them, that are taking the time off, that are spending the money for their care, that are dealing with the emotional part as well of their loved one, not remembering their names, right? So this is a benefit to help them as well. We have a business partner who he doesn't own a home right now. He's not married. He doesn't have any children, but he has over $2 million in coverage specifically for these living benefits because he says, I know if something happened to me and I got sick, my family would do everything in their power to take care of me, right? They would take out a loan on their home. They would put all their money together to make sure that I was taken care of and that I could live. So this is not just for you, but also for your family. But let's look at Mr. Start Late, right? So we're going to look at that number that I told you guys before. And then Monica, if you can help me calculate just because I'm on a different screen here. But as you can see, right, he's putting in 150 a month, which is 1,800 a year. We increase it to 3,000 after a few years because he's anticipating again to get raises and progress in his career. Goes up to 4,200, 5,400, and then he levels out at about 6,000 a year, which is 500 a month, which is the average of what we see our clients put into their retirement accounts, right? So over that 35-year period, he contributed 181,200 into this account. And very similar to King David, right? He's almost at 500,000 in his cash value by just putting that 181,000 in the correct financial vehicle. If we scroll down to the bottom here, at age 70, we're turning on that lifetime income benefit, right? That pension-like benefit that he cannot outlive. So he will be getting $78,948 per year for the rest of his life. But if you look just at these first 3 years of receiving that money, he already received 236,844, which surpasses the 181 that he's put into this plan. Plus, he still has the living benefits. Plus, he still has over 1 million in death benefit if something were to happen to him, right? So this looks pretty good, right? Would you guys agree this looks like a pretty good plan? So the reason why I wanted you to write down that number is because it does make a difference. The time makes a difference, right? At age 69, we saw King David had 1,956,000 something, right? How much does this young man here? He put in maybe 30 so thousand more. And at age 69, he has 1,096,000. Sounds pretty good, right? But that's over how much difference? 800, almost 800,000, $900,000 difference, right? So can you imagine at age 70 what King David's lifetime income benefit is going to look like? Almost double this. He'll be in six figures in his lifetime income. I would love to set up my kids like this, right? I have plans like this for all of my kids because I know with something like this set up for them, they're going to make decisions differently in their life, right? They're not going to stick with a job just because of benefits or just because of it, it pays better, right? They will have options in their life. They will have the ability to dream bigger, do more things, right? We all want better for our children. So this is where we call it Mr. Start Late and Mr. Start Early. Both plans look amazing, but almost $900,000 in difference because King David's family started a little bit earlier. So that's what we mean when time matters more than money. Again, he's not paying into this plan anymore. He's collecting that lifetime income benefit. It is a permanent plan that will cover him all the way till age 120. By age 100, he would have collected almost 2.5 million already in income, right? So pretty great return from a $181,200 investment, right? If he lives a long life, which I believe he will, because the number one stress for people that causes health issues is finances. And this guy's not going to have that issue, right? So he can make it to age 120, and his lifetime benefit at that point, $4 million he would have collected by putting 181,200 into this plan. And still will have 88,687 to leave behind to his family to make sure his final expenses are taken care of. Right. So this is why we are so excited about this plan, and we want to share it with as many people as possible because it's so powerful in really shaping our children's future, our young adults' future, or even our own if you do not have something in place for yourself. Right. So again, why do we start early? Because there are lower monthly and total contributions. There are more years for that compounding growth, which you saw, right? The difference of almost 900,000 between the two. Um, Greater long-term cash accumulation, future financial flexibility. So this one, I don't think we talked about too much, but unlike a 401k plan, King David or the other young man is not going to have to wait till 59 and a half to access their money. As long as there is cash value in there, they can access that money and use it for what they need it for. And then that lifelong insurability, right? We never know what is going to happen when our kids are healthy now, but something can happen to them now in their 20s and their 30s that could potentially make them uninsurable when it comes to life insurance. So locking in this insurance for them early gives them that lifelong insurability because once they have the plan, it cannot be taken away from them because of medical issues, right? So again, as I've been saying all along through this presentation, time matters more than money. So what are your next steps if you're on here? The next step would be to get back to the person that invited you. Number one, thank them for sharing this information with you. And then number two, set up an appointment with them so they can explain to you how you can structure a plan like this for your children, your grandchildren, or even for yourself. And just let us help you create $1 million babies. So again, we do this call every Wednesday on the West Coast here. It is at 6:30 p.m., 8:30 Central, 9:30 East Coast. If somebody came to mind while you're listening to this that you feel really needs to hear this information, you can either one, refer them back to the person that invited you, or two, refer them to this call next Wednesday, and we will be happy to share all of this amazing information with them again next week. Thank you all for joining us tonight. Thank you, Monica, for co-hosting with me. And thank you all for your patience through our technical difficulties in the beginning.
Thank you,
Have
Marlena. Thank you, everybody.
you have a
Thank you,
wonderful
ladies.
day, everybody. Thank you,
Thank
Keith,
you.
George, Betty. Have a good night.